you having trouble keeping all the retirement plans straight in your head, figuring out the tax consequences? Then this is the right video for you. I'm Brian Marks, president of Notman Marks Financial Training, and welcome to The Vault. What we're going to talk about in this lecture is specifically handling the tax consequences of retirement plans. We're not going to talk about the details, just the tax consequences. So let me start with some definitions. Then I'm going to give you a chart. I apologize in advance for my handwriting, but I'm going to give you a chart to help you remember where each of these falls. Let's start by defining what it means for a retirement plan to be qualified. A qualified plan offers pre-tax contributions. Those contributions grow tax deferred, and distributions are fully taxed as ordinary income. So the money goes in pre-tax, so it comes out of your paycheck, so you don't pay tax on it. It grows faster. When you take the money out, you haven't paid any tax yet, so everything you take out is fully taxed as ordinary income. A non-qualified plan is after-tax contributions. So you pay tax, you pay income tax on that money at the time you receive it. It still grows tax deferred, but when you take money out, you already paid tax on the money that went in. So when you take money out, the distributions are taxed only on the growth. There are some other consequences to qualified and non-qualified from a protection perspective and legal perspective, but as far as we're concerned for the test, the focus for qualified and non-qualified is on the tax consequences. This is really, really important, and this can apply to corporate plans, IRAs, and variable annuities, as I'm going to talk about on the ensuing slides. The goal of this exercise is to give you a visual framework to work through the questions. We're not going to talk about the details of each of these plans right now. It's just to help you understand the tax consequences and to help you picture in your head when you go to a question on this topic. We're going to start first by talking about corporate plans. And a corporate plan can be either qualified or non-qualified. Qualified or non-qualified. What makes it qualified? If it's non-discriminatory and it's offered every full-time employee or full-time employee equivalent hours and who's been with the firm for at least a year. And remember, what does it mean if it's qualified? It means it offers pre-tax contributions. Excuse my handwriting. It offers pre-tax contributions. Now, within that, there are two types of qualified plans. The first type is a defined contribution plan. And there are a bunch of these. There's a 401k. I'll list them and then I'll talk about them. There's a 401k. There's a SEP IRA. There's a KEO. That's for self-employment income. There's an employee stock ownership plan. And there's a profit sharing plan. What does it mean that it's a defined contribution? It means the retirement income depends upon how much an employee contributes and the performance of those investments. Maybe you understand this with a 401k. If you don't contribute anything to a 401k, you're not going to have anything at retirement. So the burden here is on the employee. The burden is on the employee. Now, the alternative to that is a defined benefit plan. A defined benefit plan is a pension plan. And in a defined benefit plan, the burden is on the employer to come up with the money. So a pension plan might tell you, if you work with us till you're 60, we'll pay you 50% of your salary for your first 5 years after retirement. That's a defined benefit plan. The burden is on the employer, and it runs the risk of being underfunded if the company doesn't have the money. 401ks and defined contribution plans are much more common now. Now, a non-qualified plan is going to be after-tax contributions. It's going to be after-tax contributions. And the most common of these is what's called a deferred compensation plan. That's generally for company executives. Okay, there's also what's called a payroll deduction plan. The details of these plans are not that important. The critical element to know here is after-tax contributions. By the way, it's also not protected from creditors if the company is insolvent. Qualified plans are basically insured by the government. A creditor can't claim the assets in your 401k if your employer goes bankrupt. Okay, so that's qualified plans. So hopefully you can picture, this is qualified corporate plans, non-qualified corporate plans. Hopefully you can picture this chart in your head on questions like this even if maybe the handwriting is a little cleaner in your head than it is on my sheet. Now let's shift gears and talk about IRAs. An IRA can also be qualified or non-qualified. What makes an IRA qualified? An IRA can be qualified if you're ineligible for a qualified corporate plan. So if you work for a company that does not offer you a 401k, you can have a qualified or pre-tax IRA. What if you work for a company that offers you a 401k? Can you have an IRA? Sure you can. But it's going to be non-qualified. It's going to be after-tax contributions. You might say, well, Brian, if it's going to be after-tax contributions, what's the point? Well, it still grows tax-deferred. It still grows faster. And it's still forced retirement savings. Okay, so it grows faster, but it's going to be after-tax contributions. How about variable annuities? Variable annuities can also be qualified or non-qualified. For most people, a variable annuity is non-qualified. It's only qualified for public sector employees. So if I work for a hospital or a public school or a nonprofit, I can't have a 401k because the 401k is only for the private sector. So therefore, I have a qualified variable annuity. This is called a 403b plan. What about if you work in the private sector and you're offered a 401k? Can you have a variable annuity? You sure can. It's going to be non-qualified. It's going to be after-tax contributions. So you might say, why would you have it? Well, it's for additional retirement savings. It's for forced savings. There's a life insurance component to it, which we're not going to get into now. But again, for most people, if you work in the private sector, your variable annuity, like for most of you, would be non-qualified or after-tax. And one more thing here. There's a separate category of plan that's neither qualified nor non-qualified. It's a series of plans that offers after-tax contributions, with tax-free distributions. After-tax contributions with tax-free. You don't pay a dime of tax when the money comes out. And there are three of these. There are three of these plans. You have a Section 529. That's for education. You have a Covered L educational savings account. As you could probably guess, that's also for education. And you have a Roth. There's both a Roth IRA and a Roth 401k. Again, these are after tax going in. When you take the money out, you don't pay a dime of tax. The first two here are for education. And the last one, a Roth, maybe you're familiar with. It's a traditional retirement plan, but after tax contribution. So again, when you get a question on the exam on retirement plans and tax consequences, hopefully you can picture in your head where these fall on the charts that I've outlined, whether or not it's a corporate plan or an IRA or a variable annuity, or it's one of these after-tax contributions. I hope you found this helpful, and I look forward to your continuing with the vault. Thanks very much.